Could Proposition 19 be a good thing or a total disaster for your family's estate planning? Stay tuned because we're going to interview an estate planning attorney who knows which way is up. Okay, so I'm super excited. Here we are with Paul Velasco from Velasco Law Group, and he is going to tell us everything we need to know about Prop 19. All right, take it away, Paul.
All right. Well, thank you very much, Kelly. I appreciate it. Let's talk about the huge impact that it has made on California real property taxes. It has two major changes. Prop 19 brings two major changes to the current law. The first one is restricting transfers between the transfer exclusions for transfers of property between parent and child. As you all may know now, when a parent transfers a property to their children, in most situations, those transfers are going to be exempt from reassessment. So a parent who may have had the property for many, many years transfers and has a very low property tax base may transfer that property to their children and the property tax wouldn't change. Well, that has been changed substantially, and I'm going to talk in detail about that in a moment. And that law goes into effect on February 16th. So there's a very short window to do anything about that if you want to do some planning. The other thing that Prop 19 did is it expands the rules for homeowners who are 55 and older, also for disabled homeowners and natural disaster victims, such as wildfire victims. It allows them to be able to, it expands the rules that allows them to be able to purchase a new property and transfer their old property tax base from their prior property to the new property. So we'll talk about that as well and how Prop 19 impacted that current law. So before I talk about Prop 19, you have to understand where we're coming from. Where we're coming from is California in 1978 passed Proposition 13. Proposition 13 limited annual increases in property taxes and the assessed value of a property to no more than 2% per year. Now, let me give you some perspective on that. Most states in the United States do not have this kind of a law. In most states, your property tax values are based on the current value, which is reassessed every year based on the current value. But California, since 1978, did not allow for that. Now it's only 2% under the current law. They can only increase your property taxes by no more than 2% per year. Now, in California, property values increase much substantially more than that. Most, on average in California, property tax or property values increase by somewhere between 6 and 7%. So if we had to have property taxes every year based on current values, it would be pretty onerous.
My family actually has investment properties, and those are supporting my parents' retirement. So we're very grateful for Prop 13 because it has safeguarded that tax base.
No question. If you think about somebody who bought their property for a couple of $100,000 many years ago in the 1980s or 90s, and now that property may be worth a couple of $1 million, that's a huge difference in terms of property taxes if it was based on the current value, which I'm going to show an example of in a moment. So the effect of the result of Prop 13 is that the assessed value of California real property for property tax purposes is more often than not far less than its fair market value. So, it's not unusual for a property to have an assessed value that is less than 20% of its fair market value. And let me give you an example of that. So there's a client who purchased a house in 1980 for $500,000. The current fair market value of this property would be $5 million. But the assessed value for property taxes is only $1.1 million because there have been increases over the year from that original $500,000, but has been capped at 2%. So that property that was purchased for $500,000 is now worth $5 million today, only has an assessed value of only $1.1 million, right? So the annual property taxes on that would be $13,750. If that house sold to a new owner, the property taxes would increase based on its current fair market value to $62,500 per year on a $5 million property. So you can see that what Prop 13 has done for us over the years for all real property owners. The other thing that Prop 13 did, by the way, is it prohibited reassessment of a new base year, except when there's a change in ownership, right? So property taxes do increase, of course, in California when property changes hands. So if there's a change in ownership, or you did new construction on your home, or you did major improvements, then the property taxes are going to go up as well. So those are the two instances under Prop 13 in which property taxes can be reassessed. So it begs the question, what's the definition then of a change in ownership? What does it mean when there's a change in ownership for property tax purposes? Well, you might think that it's very, it seems intuitive. Well, if the property changes hands from one owner to another, that's a change in ownership. But what if instead of that, there was simply, I leased my property out to somebody for 35 years? Is that a change in ownership? What if instead I gave my property to my child, but I reserved the right to live in the property for the rest of my life? I reserve a life estate. Is that a change in ownership? So you can see it's not as clear as it may seem at first blush. So in most cases, though, that we're going to be talking about here, we're talking about transfers between parent and child, where a parent takes the property that they currently own, changes the title and adds their children, or either adds their children to the title or transfers that property to the child. That is going to be a change in ownership, assuming that there are no other conditions to that. They're not reserving any other rights. They're simply transferring it to their children. It's going to be a change in ownership. So for purposes of our conversation, that's what we're going to focus on, right? So it's a transfer of a present interest in a real property, including the beneficial use of that property. Of course, it makes sense that they should be able to use the property as well, and that it's basically a quick claim or grant deed of the property to the other owner. That's a change in ownership. Now, the parent to child transfer is certainly a change in ownership. If I'm transferring my property to my child and now I'm no longer on the title and I've changed the property to the child, well, that's a change in ownership, but there are exceptions to that rule. So a change in ownership under the current law does not include a transfer between parent and child. And by the way, that can go either way. The child can transfer the property to their parents, so it can go back and forth, and there would still be no change in ownership and therefore no reassessment of the property taxes. So that is true for your principal residence. So if I were to transfer my principal residence to my children, no matter what the value of that residence is, there would be no change in ownership. There would be a complete transfer of my current property tax base to my children. Property taxes would not change at all. Even if my residence was worth $20 million and I've had it for 40 years, still no change. The other exclusion from reassessment for transfer between parent and child is that the first $1 million of base year value of all other real property, not your personal residence, but residential rental properties, commercial properties, vacant land, any other properties that you have, you can transfer, each person gets to transfer $1 million worth of property of base year value, not fair market value, base year value. Let me explain that these two things in an example. So example number one, let's talk about the transfer of the principal residence. So a mother owns a principal residence with a current fair market value of $2 million, assessed value of $500,000. The current property taxes are $6,200, $6,250, and the mother transfers her principal residence to her child. That can be either during lifetime or more typically at death. That transfer results in no reassessment because the principal residence can be transferred to a child without incurring a reassessment. So no reassessment for transfer of principal residence between parent and child. The children maintain their mother's trended base year of $500,000.
And I just want to jump in here and reaffirm, this is the current law.
That's correct.
And these are the things that are shifting as a result of Prop 19.
That's exactly right. And thank you for the clarification, Kelly. So let's talk about example number two. Remember, we said not only your residential property, but also of other properties. So let's go to that example. So now mother owns the following rental properties. She has a rental property that's worth $1.5 million. The fair market value today is $1.5 million, but an assessed value of only $355,000. You can see the value of rental property number two and the assessed value. Property number three is currently valued at $1 million, but the assessed value is only $300,000. So if you add those up, the total fair market value of all the properties is $3.7 million, but the total assessed value of those properties is only $975,000. And you find that information, by the way, on the property tax statement. You look at the property tax statement and that'll show you the current assessed value of the property. And so if mother transfers all those rental properties to her children, again, either during lifetime or at death, under the current law, no reassessment because she has $1 million worth of assessed value that she can transfer. So you can see that this can be very valuable in situations where people pass away, they own multiple properties. Many of those properties, especially if they have a very low assessed value because they've held them for many years, those can be passed on to the children without any reassessment. So the month, in this case, can transfer that real property to the extent of $1 million of assessed value and no reassessment. All right. So hopefully that was clear, those two examples, and you see what the current law is. Now,
I do have a quick question.
yes.
Don't want to get into the rabbit hole too deep on that, but let's say that the assessed value of a bunch of properties in an estate do go up over $1 million. Are you only reassessed for what is above and beyond that $1 million?
Yes.
Okay.
That is correct.
Okay.
So if they have a number of properties beyond that, yes, those other properties would get reassessed. Exactly right.
Got it.
Good question. All right. So before I talk about, which I'm going to get into right now, how Prop 19 has changed the current law, I want to make a little bit of a comment about trusts and change in ownership, right? Because if you own property in your individual name and you're transferring between parent and child, well, that's very clear to the assessor. It's just a transfer between parent and child. You fill out an application saying, I'm the parent, they're the child. There's no reassessment. But often these properties are held in trusts. And so there are rules also for trust. The rules are a little bit different, but you have to look at those rules. And the main rule, the general rule, is that a transfer in and out of a trust or the termination of a trust is a change in ownership unless an exception applies. So let me give you an example. Let's say that I create a trust and I leave the property in trust for my wife for her lifetime. Well, transfers between spouses are not a change in ownership. So if I create the trust, I transfer the property to the trust and she is the beneficiary, no change in ownership because she's my spouse. But when that trust terminates, the terms of the trust say at her death, the property then goes to my brother. Okay? Well, that termination of the trust is a change in ownership. And because my brother is not a child of mine, there are no exclusions or exceptions for transfer between siblings. So it would get reassessed at that time. Because the trust is terminating, you look to see who's getting the property now after the termination. If an exclusion doesn't apply, then it would get reassessed. Now, if instead of passing to my brother, it passed to my children under the current law, to my wife first for her lifetime, trust terminates when she passes away, goes on to my children. Because there's an exclusion for transfer between parent and child, there would be no reassessment in that case. Okay, so you can see that the rules are a little bit different for trusts. You always have to look through the trust to determine who is the present owner of the property for property tax purposes. Because the person who is the beneficiary of the trust is the person who is counted. So if I transfer a property to a trust and my child or children are the beneficiaries of that trust, again, that parent to child exclusion applies. In a revocable living trust, if I just create a regular revocable living trust like most people do to avoid probate, I'm transferring my property into my trust. Well, in those cases, the creator of the trust is also the beneficiary. So when I create a trust for myself, I'm also the beneficiary of that trust. So again, no change in ownership. I'm still the owner of the property when I transfer it to the trust. So an exclusion applies. Even though it's a transfer into a trust, I'm still the owner, no reassessment. There's also, as you may know, irrevocable trusts. So in addition to revocable living trusts that people can create, parents often create irrevocable trusts as well for estate and tax planning purposes. So again, same thing. We have to look to see who is the beneficiary, the present beneficiary of that irrevocable trust. If it's a child or a children under the current law, again, if the beneficiaries or the children have present beneficial ownership in that trust, no reassessment. Okay, so those are the rules for trusts. Now let's talk a little bit about how Prop 19 impacts Proposition 13 and the current property tax laws. So as we just talked about, until passage of Prop 19, clients can rely on Proposition 58 to pass. Proposition 58 is the one that says there's exclusions for transfers between parent and child, to pass their annual property tax savings from that Proposition 13. So somebody who purchased their property many, many years ago would be able to transfer their property to their children under the current law. But this changes that. This changes that. It's a very big change, which I'm going to talk more about in a second. So that's one impact. The other thing is that, and by the way, this loophole closes on February 16th, right? There may be a way to plan around that, but right now, this whole Proposition 58 thing goes away effective February 16th, 2021. So with respect to your primary residence, there is going to be that application there. In other words, there is still going to be an exception, but it's severely restricted. And I'll show you how in a moment. Right. So the other thing is that, so for transfers between parent and child, then effective February 16th of this year, the $1 million of assessed value, parent to child exclusion, remember you said of anything other than your personal residence, your non-principal residence, you get to up to $1 million of exclusion from reassessment. That is completely eliminated. You don't have that $1 million exclusion anymore. So any rental properties, any commercial properties that you're passing down to your children, vacant land, whatever you have, if it's not your personal residence, it's going to get reassessed on transfer to your children, either during lifetime or at death. Right? So that's the first thing we lost with Proposition 19. The parent-child exclusion for your principal residence remains, but it is severely limited. So in two ways. Number one, in order for this to apply now, the parent-child transfer for a principal residence, in order for that exclusion to apply, the child must also use it as their principal residence and file for homeowners exclusion within 1 year of transfer. So in other words, it's not enough that it's just the parent's principal residence. It also now has to be the child's principal residence. And they have to make that so within a year of the transfer. So if within 1 year, the child makes that their principal residence, then the rule applies. But the exclusion is now limited. Remember I said before that the value of the house, it wouldn't matter how much the value of the house is. It could be $20 million and there would still be no reassessment. That is changing. The exclusion is now limited to the house's base year value. So whatever it is at the parent's death, that base year value plus $1 million. That is it. That's the extent of it. So here's how we apply the rule. Here is the rule. I'm going to read the rule to you. You can see it there on the screen. I'm going to read it to you. It's going to sound a little bit disjointed or it's not very clear, but you're going to see from my examples how clear it is, in fact. So if the transfer meets the principal residence requirements, so as again, you've got to be the parent's principal residence and the child's principal residence. If it meets that requirement, the child's assessed value is determined based on whether the property's fair market value at the time of the transfer exceeds the parent's assessed value by more than $1 million, right? So if the fair market value of the property is if you look at the assessed value, you take the fair market value of the property and you subtract the assessed value. If that exceeds $1 million, then a different rule applies. So I'm going to show you. So here's the first example. So at the bottom there, if the fair market value of the property it's assessed at the time of transfer exceeds the parent's assessed value by less than $1 million. So if that difference between the fair market value of the property and the assessed value of the property is less than $1 million, then the child takes the parent's assessed value. There is no change in the assessed value. Okay? I'm going to show you that with an example. So here's the principal residence. Fair market value of $2.5 million. Parent dies. The assessed value of the property at the time of death was $1.6 million. So we do the calculation. Fair market value, $2.5 million, minus the assessed value, $1.6 million, that is $900,000. So since the fair market value exceeds the parent's assessed value by less than $1 million, there's no reassessment. The assessment stays the same. So the child inherits the property tax base of the parent. That is the rule, okay? Now, let's talk about that rule where the fair market value exceeds the parent's assessed value by more than $1 million. So if that happens, the rule is at the bottom, if the fair market value of the property at the time of transfer exceeds the parent's assessed value by more than $1 million, then the child's new assessed value is the current fair market value of the property minus $1 million. Remember, you only get $1 million of exclusion now. So let's run through that with an example. So the principal residence here is again $2.5 million at the time of death. The assessed value of the property is $500,000. So now we do the calculation. The current fair market of the property, the current fair market value of the property minus the assessed value, that's $2 million. Well, that's more than $1 million. So now, since the fair market value exceeds the parent's assessed value by more than $1 million, the child's new assessed value is the current fair market value of the property, $2.5 million, minus $1 million, $1.5 million. So now the new value in the hands of the child who is living in the property is 1.5 million instead of 2.5 million. But you don't get the $500,000 of assessed value that the parent had. So you see, there is some limitation on how that rule works now. Those are transfers now between parent and child. So any questions about that, Kelly? I know it can be a little bit difficult to follow the rule, but I think with the examples, it helps.
Yeah, no, the examples are great. And it's also really speaks very loudly to the fact that people really need to be aware of this change coming very quickly, because this is going to impact families for generations.
Right. So instead of now keeping these properties because they have a very low property tax base, children who inherit properties now are probably not going to be able to afford. Many of them will not be able to afford the property taxes on these properties, and so they will have to be sold. Right. So now, there are opportunities for planning to limit the effect of Proposition 19, but as you can see now, because that proposition goes into effect on February 16th, there's very little time. We have about 3 weeks, probably even less than that, to do any kind of planning. But it involves major changes to property ownership. If you're going to do any kind of planning, there are changes that would have to take place. So parents have to understand that if you're going to be involved in doing transfers to avoid that change in the law as of February 16th, you have to transfer title to your real properties to your children before that day. So that involves transferring title to the properties today, not waiting until you pass away. That's a big change for many people. You're going to lose control over the property that you transfer. You no longer own that property, or if you're transferring a certain percentage, you're going to lose control over that percentage. It's giving your children control today. You'll lose income from the transfer of those rental properties. They no longer yours. They belong to your children now. And that income will go to your children if these are rental properties or commercial properties, and you're living off that income. If you can't afford to lose that income, then you may not want to do that kind of planning. Transfers of property to children limit your ability to refinance properties in the future. If you want to do some kind of refinancing of those properties, or sell the properties and use that to do something else, of course, that's going to limit it. So you have to realize that these things are going to happen if you want to do any planning. The other thing is that this type of planning involves irrevocable transfers. These cannot be easily changed or reversed without adverse tax consequences. It used to be when we did some kind of irrevocable transfers, irrevocable trusts, if we for some reason wanted to unwind that trust some years later because of some change in circumstance with the family, we could get it back to the parents. Remember, that parent-to-child transfer rule today works both ways. So we could transfer it back to the parents easily without incurring a reassessment. Not so anymore. Once you transfer it out after February 16th, a transfer back to the parents is going to result in a reassessment. And then, while this transfer certainly preserves the parent's property tax base for the children, it comes at a cost, because there may be a loss of income tax benefits for transfers of real property during lifetime. And I'm going to explain that in a moment a little bit more. But you can see that these are the things that are going to happen if you're going to be involved in this type of planning. So it may not be for you. And as I said, for many of my clients, it makes no sense to do this kind of planning now. It's not going to change. Prop 19 is not going to change your property taxes now if you maintain your ownership. So it only involves changes when a transfer is made, when there's a change in ownership. All right. So what are some of the considerations in doing this type of planning? Well, you're only going to do this kind of planning if you have property where the current fair market value is much higher than the assessed value, right? If you recently purchased property and your property taxes are high and there's really not much of a difference between your fair market value and the assessed value, then you're not going to do anything. This planning doesn't make sense for you. It's only where there's a big difference, a big disparity in the fair market value of the property versus the assessed value. It's going to make sense only if the client has at least one child and the children intend to retain that property for many years after the client dies. If the children are going to, and this only applies for children, of course, but if the children are going to sell the properties, if the plan is that they're going to sell the properties after the parents die, then it doesn't make sense to do anything. It's not going to matter that the property taxes are going to go up, because the properties are going to be sold anyway. So only if they intend to keep these properties for many years after the client dies are you going to engage in this type of planning. And many of my clients do fit this mold. Many of my clients and their children want to ensure that the property taxes are going to stay the same because they intend to keep them as rentals. So that'll have to be the case. The other thing is the client can presently afford to give away the real estate right? Including the income from there. Remember, as I said earlier, it involves transferring title to your children now, which means all the income from those properties are now going to your children. So if you're living off these income, the income from these properties now, then this kind of planning may not be for you. The other thing to consider is that it can only work if the client has not already used or consumed the $1 million of assessed value for properties other than a personal residence. Certainly you can do it with your personal residence as well. So if you have a personal residence, you have the homeowner's exemption on that residence, you can still transfer it. But for anything other than your personal residence, if you've already used that $1 million of assessed value for exclusion for transfers between parent and child, then the planning is not going to work. And I do have clients who fit that mold. Clients who over the years, because the property tax assessor keeps track of these things. They know over the years, if you've transferred properties back and forth, they keep track of that and they see how much of your assessed value has been used. And if you've used it all up, well, then transfer of property now after you've used it all up is going to result in an immediate reassessment. So you can only plan where you have not used your entire $1 million of assessed value exclusion. All right, preserving the parent's base, property tax base on the value is, if that's more important to the client's children than obtaining a stepped up basis on the property at the death of the parent, then this planning makes sense. Let me explain that a little bit. So as you know, when you sell property, if I purchase a property for $500,000, that is my tax basis, my income tax basis. Now I'm going to be talking about an income tax, not a property tax. This is an income tax issue. So if I buy a property for $500,000, my tax basis, my income tax basis on that property is $500,000. If I sell it in the future for $1 million, well, I'm going to have a capital gain. The gain is the difference between my basis and what I paid for it. Okay, that's a huge number. $500,000 gain. I'm going to pay taxes, depending on my tax bracket, anywhere from 20 to 30% in capital gains taxes between state and federal. If instead I keep the property instead of selling it and I give it to my children, again, under the current law, if I give it to my children at death, my children now get a stepped up basis on the property. Their basis for determining capital gains is no longer what I paid for it, the $500,000. Rather, it's the date of death value. That now becomes their basis. So if they sold the property right after I passed away, a fair market value, their basis is $500,000. They sell it for $500,000. Zero gain, no capital gains taxes. So getting a stepped up basis when you transfer to your property to your children at death is a huge benefit. But when you transfer during lifetime, it is a carryover basis. The parent's basis in the value, income tax basis in the value now becomes the child's income tax basis. So when the parents die, the property had already transferred during lifetime, there is no stepped up basis. So in the future, when the children go to sell that property, there is going to be a capital gains tax, much larger than there would be had the parents transferred it at death instead. So you can see you're trading one tax for another. Now, again, in those situations where the children intend to keep the properties for 10, 15, 20 years, and they want to reap those benefits of keeping the same property taxes, they don't intend to sell it, then losing the stepped up basis may not be as important to them. So you can see from all these considerations that this is all very client specific. Everybody.
So it's interesting because I remember when the tax break of $250K for an individual for capital gains on a home sale and $500K for couples, that seemed like such a great break. But now with property values so high, it's not the break that it once was. It's a very different thing.
You're right. Many people who sell their residence end up still, even with that exclusion, even for a married couple who can double that up and get $500,000 of exclusion, will still sell a property and the gain will be higher, their principal residence, and the gain will be higher than that, and then having to pay some capital gains. We may not have that at all in the future, even if people make the decision now to say, well, stepped up basis is more important to me than property tax basis. So we're going to keep the properties and we'll count on getting the stepped up basis when we pass away. But that may not be here either, depending on how the laws change in the future.
What if the family's estate, all of the various properties, a primary residence as well as rental properties, are in a trust? Do they still get reassessed? Do the children still get reassessed when that property comes to them?
So there's no difference between ownership in an individual capacity or where your properties are in a trust. There's no difference because we look through the trust to see who are the true owners of the property. So if I, in my individual capacity, and I own my properties in my name and I'm transferring it to my children, then the parent-to-child rules are going to apply either way, either under the current law or the old law. It doesn't matter. Either way, those parent-to-child transfer rules apply. If instead I have it in a revocable living trust and I'm transferring to my children, it's the same rule. Doesn't matter whether it's in a trust or not. The rules are the same both under the prior law or the current law and under Prop 19. You just look through the trust to see who the owner is.
So just for further clarification, it's all in a trust. You've got the primary residence under current law that's coming into effect on February 16th. Make a note of that date, people. That the primary residence, if the child that inherits that moves into it and takes it as their primary residence, then they have $1 million of pad basically before a reassessment.
That's correct.
Okay. But rental properties completely off the table. They are going to be reassessed straight out, whether it's in a trust or not in a trust, doesn't matter. You're going to get reassessed.
Yes, after February 16th, transfers of anything other than your personal residence going to be subject to reassessment.
So do you have any strategies up your sleeve for how to work with this to the best benefit for people who are trying to manage their estates?
Well, yes. So in those situations, and again, this is very client specific, so I'm not speaking in general terms for everybody. In order for them to be able to determine whether or not this is right for them, they have to speak with an attorney who knows what they're doing, who's familiar with these laws and the planning methods, and can speak to their particular circumstances and whether it makes sense for them and make recommendations. But in general, yes, for those clients for whom it makes sense to do these kinds of transfers, there are a number of ways that they can be accomplished. So I'll give you an example of clients that we're working with now and what we're doing. So I have a client who's got multiple properties. They have their home and they've got 4 rental properties as well. And they've held these properties for many, many years. And so they have a very low property tax base and they want to preserve that for their children because their children want to keep these properties for many years. And it would be a huge difference if they were to get reassessed after their parents pass away after February 16th. So what we're doing is this. We're creating an irrevocable trust for those children. And so we create now an irrevocable trust for the children, and the children are the beneficiaries of that trust. The parents are now going to gift 50% of those properties into the trust, not the entire thing, because the parents still need some of that income, right, to live off. They don't need all of it, but they need some. So we're now going to transfer 50% of those properties into the irrevocable trust, and we apply today for that parent-child exclusion under Prop 58. We do that before February 16th. So we create the trust, we transfer 50%, and now the children own 50% of the properties, the parents own 50% of the properties, and then we create an LLC, a limited liability company. The parents then transfer their 50% into the LLC, the children transfer their 50% into the LLC, and that's where the properties sit. And now the LLC owns these properties. And the income from these properties are paid 50% to the parents and 50% to the children and to the children's trust. So now the parents have use of some of these properties. The other thing that this has the benefit of is that when the parents pass away, the rules for transfers of property within an entity are different than the rules of transfer between parent and child or individuals. In an entity, if there is a change in ownership of more than 50% of the entity, of change in ownership of more than 50% in control, there's a reassessment of all the properties within the entity, within the LLC. So when the parents pass away, they're only transferring 50%. It's not more than 50%. So there is no exclusion, there is no reassessment of the entity, the properties within the entity. So now we've been able to get all of those properties over to the children. We allowed the parents to keep some of that income during their lifetime. And for that portion that the parents kept, the 50%, there's a full stepped up basis on those properties to the date of death value. So they still got some stepped up basis and they got all the property tax savings over to the children without there being a reassessment. So that's one example of things that can be done to help. with clients.
That really helps clarify. And then if the family, that we're imagining, like if the parents needed all of the income from the properties, because that's what they're living on, that can be managed, I'm sure, some way legally, so that.
But in certain situations, it may be, so now we're going to talk about a little bit about estate tax issues, right? Because these transfers, this type of planning is very complex. It involves property taxes, income taxes, and the capital gains, and estate taxes, right? Because today, people can give away up to $11.7 million of property without incurring a gift or estate tax. So that's a different tax I'm talking about now than I've talked to about this whole conversation. The estate tax, right to transfer property from one generation to the next without paying estate or gift taxes. And the amount that every single person gets to do that is 11.7 million. Okay. So some clients, if those clients are in a situation where they have properties, they have assets or an estate that's higher than that, then we want to gift these properties over. And when they gift these properties, by the way, they're using some of their $11.7 million exclusion, right? They're having to report that in a gift tax return to the IRS. Hey, I'm giving away properties today. I'm using some of my exclusion. So it reduces that $11.7 million. And that's okay. And it's actually a good thing for clients who have large estates to start getting property out of their estate now, right? But if when they pass away, the IRS determines that in fact, some of that income was going over to the parents still, the IRS is going to say, well, you may have transferred it over for property tax purposes during your lifetime, but for estate tax purposes, since you kept control, since you kept receiving the benefits of this property by receiving the income, we're going to say that it's still part of your estate for estate tax purposes, and it's going to be taxed now, subject to the estate tax. So in situations where you do that kind of reserve that kind of cash flow over to the parents, there's going to be a problem on the estate tax side. You're going to get taxed for the estate tax. In situations where there is not a concern about the estate tax because the parent's estate's not large enough at this point to incur a tax, then yeah, the parents can still receive that income. The children can continue to give it to them with it doesn't matter. It doesn't matter that it would be.
And that's that 11 million and change
That's
number.
correct. So let's talk about the other change in the rule. We talked about restricting parent-to-child transfers and how Prop 19 changes Proposition 58 and Proposition 13. So let's talk about expanding the rules now for homeowners who are age 55 and older. This portion of the proposition, this aspect of it goes into effect not on February 16th, but effective April 1st. April 1st with this portion of the law. So let's talk about that. Under the current law, a person who's 55 years or older can sell his or her primary residence, again, it's got to be your primary residence, and transfer the property tax base to a replacement residence. So a new residence that they're purchasing, but there are certain conditions to that. So the replacement property has to be purchased within 2 years of the time that you sell the old residence. You've got 2 years to make that change. That replacement property, and by the way, it's not automatic. You have to apply for this change. You have to file forms with the county to apply for it. So it's not an automatic thing. You got to apply. The replacement property has to be under the current law of equal or lesser value than the current property. So you can't take a property that you own today with a fair market value of 2 million and purchase a property that's worth 2.5 million and still make that transfer. This law wouldn't allow you to do that. So under the current law, the replacement property has to be of equal or less value than the replacement property. Both properties have to be within the same county in California. So you can't go from LA to Orange County or from LA to San Diego County. It's got to be LA to LA or Orange to Orange. And only certain properties right now in California participate in that. Now, fortunately for us in Southern California, most of the counties in California do participate. So LA County, Orange County, San Diego County, San Bernardino County, they do allow for this type of transfer, but most of the counties in California do not. So it's very limited under the current law. And it's only a once in a lifetime use. If you used it once already to transfer a property that you sold, to transfer the property tax base to a new property that's equal or less value, you can only do it once in your lifetime, and that's it. So that's the current law. So let's see how the new law changes that. So first of all, it applies now not only to 55 years or older, but to somebody who is severely disabled or somebody who is a wildfire victim, then they also get the benefit of this law. They can sell. So even if they're not 55, but they are disabled or a wildfire victim, they can sell their primary residence and transfer that property tax base to a replacement residence. But here are the conditions now. So it's replacement, same thing as before. It's got to be purchased within 2 years of the sale of the other property. The replacement property, it can be of equal or less value, but now it also can be of greater value than the current property. So now you can purchase a property where you have the new property is worth more than the property you're replacing. So it's greater than. So that's an expansion of the current law. Both properties can be within any county in California. So you can now do inter-county transfers and it will still apply. So you can go from LA to Orange County, LA to Marin County. It doesn't matter where you are. Transfers apply from any county, and all counties in California now participate in Prop 19, not just the limited few that there were before. So you can do this in any county in California, and it's not limited to a one-time transfer anymore. Now it is 3 times. So 3 times in a lifetime for 55 years or older, but only once for wildfire victims. I'm not sure why they have that limitation in there. I mean, if you're a wildfire victim 3 times, why wouldn't you be able to get that transfer benefit? But that's not the case. So, but it's allowed now up to 3 times for people who are 55 years and older. So that's, you can see in red are really the changes of the current law. So let's put that to an example, right? So the example that I'm going to use, of course, is where you have a property that you're purchasing, the new property you're purchasing is of greater value, okay? They're not going to just allow you to transfer, in that situation, your current property tax base to the new property. They're not going to allow you to do that. In other words, if you have a property today that's worth $1 million and you're buying a $5 million property, they're not going to allow you to transfer the $1 million assessed value you have now to a $5 million property. No.
Really? Oh man, doggone it. Seriously?
What's up with these legislators?
I know, right?
They're all attorneys. That's the problem. All right. So here's an example. If you have a property that's the current fair market value of the residence is $1 million. Again, it's got to be your principal residence for this to work. $1 million. The assessed value of that property for the owner is $425,000. So they pay property taxes somewhere in the $5,000 range. That's the principal residence right now. And now they want to buy a new residence. And the value of that new residence is $1.5 million. So if they just sold the property and purchased the new property and there's no Prop 19, if we didn't have the benefit of this law, the new property taxes would be based on the current fair market value of the new property. So 1.5 million times 1.25%, you're looking at $18,750. So they're moving into a new residence where their property taxes are now going to triple, more than triple. So how does Prop 19 help in that way? So here's what we do. If the value of the replacement property is greater than the value of the property sold, then the new assessed value for the new property is calculated as follows. You take the current fair market value of the new residence, $1.5 million. You subtract $1 million. There's your exclusion. You get to $500,000 in this example, and then you add the current assessed value of the current property, $425,000 of the property they currently own. $925,000, that is the new assessed value of the new residence. If you multiply that by the property tax rate, you're looking at $11,562 for a new property tax reassessment. Now, that's certainly higher than what I showed you before, which was $5,100 on their current residence, but is not as high as it would be if you didn't have the benefit of Prop 19. So you get that benefit. So that is how you calculate the new reassessment value when you're transferring a property of greater value to a property that's of greater value.
Has been so generous to share some knowledge with us and some great examples. I would like to tell you a little bit more about this gentleman. He has been in business for over 23 years, serving the community with estate planning. He graduated from Loyola Marymount University with a law degree. And I do have to ask you my one quirky question. So
Yes.
what do you think it is that sets you apart from other people that are in this profession?
I guess it'd be a couple of things. Number one is that I am designated as a certified specialist in estate planning, probate, and trust law. Less than 1% of all attorneys in California are certified specialists in their area of practice. So that's one thing that separates me from some of the others. The other thing is that in addition to doing estate and tax planning, which is a big part of my practice, I also do probate and trust litigation when there's fighting among the family members or there's problems and we have to end up in court. And that makes me much better planner, right? If I'm also dealing with all the problems and all the fallout that happens, sometimes because the documents were done incorrectly, it makes me a much better planner. I already know in the end, when I'm sitting with the family, it's a blended family, they have children from different marriages. I already know what the issues are gonna be and where the problems are. And so we can plan the documents accordingly. So it allows me to get a better perspective when I see the outcome at the end, how we can plan it to avoid these problems in the future with my clients.
I believe you have a little helper that we can make available to the folks that have watched this. Down in the description for the video, there will be a link and you can fill out a form and get access to, tell them what this is. It's like a questionnaire that you use with your clients.
We help clients in estate planning matters, whether it's Prop 19 or others, if they just want to have a basic estate plan to protect their family. We help clients, we do that, we don't charge for the initial consultation. But in order to be able to help them, we need to have basic information about their family and financial situation. So there's a questionnaire that we have them complete. It's confidential, the information. So they complete that, they bring that with them to the initial meeting, which we can do by phone or Zoom conference. And with that information, I can get a better sense of their family situation, answer their questions about basic estate planning, and then make recommendations for them.
Man, there is a lot to know about Proposition 19. I just did a video recently about the mass exodus from California, and I'm wondering if Proposition 19 isn't going to lead to even more of that. So if you want to check out that video, be sure to click here and watch it. Thank you again to Paul Velasco from Velasco Law Group for joining us today. I'll look forward to seeing you the next time here on Coastal Living by Kelly. Bye.
That was awesome, dude!